Leverage ratios. The next set of the ratios are called the leverage ratios. It measures the amount of the capital that comes from the debt, means loans or credit, to assess the liability of the company to meet its financial obligations. Company requires the money to run its operation, right? They can raise this money either through equity or through debt, which includes loans or the credits from the market or the suppliers. Debt has some advantages like interest payment are tax deductible. Debt does not dilute the ownership of the company like additional stock issues, but it also has a disadvantages like in the debt they has to pay back this principal with the interest to the lenders or the creditors, whereas in case of the equity debt does not require to pay back this money. This ratio provided indications of the how much the company's asset and the business operations are financed using debt or by equity. So let's start with one by one ratios and see which are coming under this group. First one is the debt ratio. This ratio indicates the portion of the company's debt to its total assets. It shows how much the company relies on debt to finance its assets. It calculated or derives by dividing total liabilities with the total assets. Total liability include the short-term and the long-term liabilities, but it does not include the equity portion. A low debt ratios always indicates the conservative financing with an opportunity to borrow in for the future at no significant risk. Generally, a ratios with 0.4, which is 40% or lower, is considered as a good ratio, but a ratio beyond 0.6 is generally considered as the poor ratios, since there is a risk that the business may not generate enough cash flow to serve its debt. Next one is the debt to equity ratio. It calculates the weight of the total debt and the financial liabilities against the stakeholders' equity. It viewed as a long-term solvency ratios. It basically the comparisons between the external finance and the internal finance. It calculates as the total liabilities over the shareholders' liabilities. In this example of the ABC company, it is showing as 0.48, or you can say 0.48 is to 1. It means the liabilities are 48% of the stakeholders' equity, or we can say that creditors provide 48 rupees for each 100 rupees provided by stockholders or stakeholders to finance the assets. A ratio, if the ratio is showing 1, it means the creditors and the stockholders equally contribute to the assets of the business. Less than 1 indicates the portion of the assets provided by stockholders is greater than the portion of the asset provided by creditors, and greater than 1 indicates that portion of the asset provided by creditor is greater than the stockholders. Creditors usually like the low debt to equity ratios. If it is less than 1, they are happy to finance that company. Next ratios is the interest coverage ratio. It shows how easily a company can pay the interest expense. This interest expense is the interest they has to pay for the debt they has taken from the market. Companies need to have more enough earning to cover these interest payments in order to survive the future financial hardships. A company's ability to meet its interest obligation is an aspect of its solvency, and thus it is a very important factor in return for the shareholders and the lenders. What constitutes a good interest coverage ratio? It varies industry to industries and also from companies to companies, but we can check whether this company is performing good with the industry peers. Generally, an interest coverage ratio of at least 2 is considered the minimum acceptable amount for a company that has a solid or consistent revenue. The next set of ratios are the debt service coverage ratios. This reveals how company easily can pay the debt obligation in full, including principals and the interest. Debt service coverage ratio is calculated as the operating income divided by the total debt service. Debt service coverage ratio above 1 indicates that the company is generating sufficient operating income to cover its annual debt and interest payments. For an example, DSCR of the 0.8 indicates that it has only enough operation income to cover 80% of the company's debt payment. In this example, it is 56.49, means is way higher than 1, means it is taking very less debt or the loans from the lenders. So it has a high capability to pay off that loan. Capitalization ratios. It shows the financial leverage of the company. It shows how much capital is financed by equities in total required capital by a company. If the percentage is higher, it means that the finance of the company mainly comes from the debt, which can be quite risky and is sometimes a reason for the bankruptcy. Higher ratio percentage shows how weak the company's financial is. Similarly, decrease in long-term debt to the capitalization ratio would means that there is an increase of risk for the stakeholders' equity. It is calculated by total long-term and short-term debt divided by the total liabilities, which includes the equity, short-term liabilities and long-term liabilities also. Next set of ratios is called efficiency ratios. It is most interesting ratios for me. This also shows the activity of the financial ratios, which shows how well the company is utilizing its assets and resources. It is an indicator of the various operating cycles. Like the first one is the receivable turnover ratios, which is derived from the sales on credit divided by average receivables. It shows how many times a company can turn the receivables into cash over the given period of the time, or we can say over the 1 year. Next one is the inventory turnover ratios. Inventory turnover ratios or inventory turnover days. It shows the company's ability to convert or sell its inventory and replace it into the cash with its given period of time or 1 year, you can say. It derives as a ratio of the cost of goods sold and average inventory. Next one is the payable turnover ratio. It measures how fast the company can pay its creditors from its cash and cash equivalents. It derived from the sales on purchase over the average payables. These all ratios can convert into the days if we divide 365 to these ratios. We can calculate the net operating cycle of the company by adding these days or the operating cycle days from these ratios, these three ratios. Like this, in this example, if we see the receivable turnover days is 32 days, inventory turnover days is 100 days, and payable turnover days is 86 days. So to calculate net operating cycle, we had to add both 32 plus 100 minus 86, means the company is generating cash using receivable turnover days and inventory turnover days. So the total will be the operating cycle by which the company is generating cash minus the company is paying cash to pay its liability, that is the payables or the creditors. So this total means receivable turnover days plus inventory turnover days subtract payable turnover days is give us 47 days. So the net operating cycle for this company is 47 days. Next is the set of efficiency ratios is the fixed asset turnover ratios is generally used by analysts to measure the operating performance. The efficiency ratio compares net set of the fixed assets and measures the company ability to generate the net sales from the fixed asset investments. It calculated by dividing operating revenue with the fixed assets. The fixed asset balance is used as a net of accumulated depreciations. A higher fixed asset turnover ratio indicates that a company has effectively used the investment in fixed asset to generate sales. There is no ideal ratios that's considered as a benchmark for all the industries. Instead, investors should compare the company's fixed asset turnover ratio to those of the other companies in the same sector or industries. Return on the capital employed. This is one of the most interesting ratios. This is the financial ratio that measures the company's profitability and the efficiency with which its capital is used. In other words, this ratio measures how well a company is generating profit from its capital. It derived from the operating income over the capital employed, that is the equity. Higher return of the capital employed indicates more efficient use of the capital, that ROC, capital. This ratio is sometimes called ROCE, which should be higher than the company's capital cost. Otherwise, it indicates that company is not employing its capital effectively and is not generating shareholders value. You can see how to calculate it. It is calculated operating income over the capital employed. Here in this case is 30.50. That's mean 30.5. It means that the company is having the capital value which is 30 times of the operating income.